Hello, and welcome to our fourth quarter 2019 strategy review. Once again, we've had an interesting amount of information that we've been dealing with at the review. And just as a little bit of history, I went back and looked at our fourth quarter strategy review in 2013. That's right, we've been doing these for 6.5 years. And at that time, we were also dealing with a government shutdown, fear that we couldn't raise the debt limit. And the reason I bring it up is that we took no overt action at that time. And that turned out to be the right thing to do. I will again remind you that all of those reviews are on our website, and feel free to go out and take a look at them. In any case, at this review, which again took place 25th of September, right here in this room, with me on my right, Len Skena, Vice President, CEO, and member of the Executive and Investment Committee. And on my left, Bob Toomey, Vice President, Research, also on the Investment Committee. And joining us on the phone, a very interesting presentation from Casey Sullivan. Casey Sullivan is a Vice President with JP Morgan Asset Management and an ETF specialist. She was able to bring a great deal of perspective to the meeting, and we really appreciated her attendance. At any rate, we were dealing with some rather interesting issues: whistleblowers, impeachment, and of course continued trade problems with China. At any case, as you'll see as we go through the review, once again we chose to take no real overt action, but we did consider all of these things as we looked at what was happening in the equity markets, the bond markets, and especially the international markets. So with that, I'd like to turn it over to Bob to kick us off on the equity markets. Thanks.
Thanks so much, Stan. So I'm happy to give a little review here on our U.S. equity outlook. You know, we continue to remain positive on equities, despite the fact that we have seen some increasing volatility here over the last year. But I would point out that volatility is a characteristic of the market that's always been there. And in fact, volatility is a necessary component of achieving higher returns. And I would point out that the volatility that we're seeing really is not that much greater than long-term historic volatility. I think it just seems that way because of the news cycle. There just seems to be more news and shocking news every day. And I think that creates a sense in people's minds that, there's more volatility. But when you really look at the underlying fundamentals of the U.S. economy, they remain quite good. Employment is strong, consumption remains very strong and healthy, technology-related spending remains very strong, and productivity is improving. And I would point out that we've seen this uptick in productivity now for several quarters, and I think that could certainly be an important factor that could allow this economy to continue to expand much longer than many people now expect. We've been hearing for years, really, the last several years, that a recession is right around the corner, and you're constantly hearing about this in the media. Those forecasts have been proven wrong over the last several years, and I think they will continue to be proven wrong currently. I think the underlying economy remains good. The other thing I'd point out about U.S. stocks is valuation remains, I'd call it benign, but I'd say it's sort of neutral at around 16 and a half times forward earnings. Stock valuation is by no means high or extended. So I think that all of these factors continue to support a positive backdrop for stocks. The risks continue to be uncertainty around the trade situation with China and the ongoing political turbulence that we are hearing about every day. I mean, these could potentially be dampers for stocks, and we're watching those very closely to see how those might play out and affect the outlook for U.S. stocks. But right now, we do not see them having a major negative impact. And I would also add that even if there is no trade deal with China, we do not see that throwing the U.S. economy into a recession. With that, I'll turn it back to Len for some comments on fixed income.
Thank you, Bob. When we met a year ago and we were talking about what was the Fed going to do, the consensus was that the Fed was going to be raising interest rates. And the question really was, how many times would they be doing that and how far would they go? At this point, a year later, things are completely different. The Fed has done a complete 180 and they are now looking at lowering interest rates. In fact, they've already begun to do so. The reasons for this are actually very, very significant. The Fed has a mandate to look at inflation as well as to try to assure full employment within the United States. And looking at both of those things, inflation does not appear to be a major concern at this time. And the numbers for employment at this point are starting to slow down a little bit, but it's certainly not showing signs of any kind of an economy that is heating up too rapidly. In addition to that, as the Fed was trying to raise rates, they ran into a number of problems. Because they only control the short end of the curve, as they raised rates, market forces, which were controlling the intermediate and the longer term ends, ended up resulting in an inverted yield curve along the way. And the Fed may have pushed things a little bit too far as they went. Other economies around the world, they were not supporting that. Their bonds were paying significantly less than the US, and the US got ahead of them by a little bit too much. In addition, we had situations where there's just a lot of uncertainty regarding things such as the trade war and the impact that that will have on future US growth. So the Fed at this point has begun to cut interest rates, and we're anticipating that they will probably continue to do so going forward for a little while. Given that, we normally would skew things more towards the longer end of the curve, but because the longer end of the curve has not risen as interest rates went up, we really don't feel comfortable putting a lot there, and we're skewing things more towards the shorter end of the curve. Our durations at this point are going to be heavily weighted towards the short end. In addition to that, we are also looking for places where we can add additional yield and additional interest into your portfolio. And for that reason, we've introduced a high yield fund that we've used in the past that focuses on short-term, high yield fixed income investments. That's something, as I said, we have used that in the past. Given the current market, high yield is representing an undervalued area where the difference between what high yield is paying and what more traditional treasuries would be paying is significant enough to more than make up for the additional risk that we believe might be introduced by taking on that fund. With that, I'm going to turn it over to Stan to talk about REITs.
Thanks, Len. And actually, I think I'd like to say thanks to the fellows here and the committee in letting me talk about REITs at pretty much every one of these sessions. REITs are an area that we all tend to favor. The reason I appreciate being able to talk about it is it was clearly the best performing group in the last quarter, as it has been for a while. Why? Because REITs basically pass through dividends, and therefore they have a higher dividend return than most other equities out there. And we have been using REITs historically, and we have in the last few quarters also segued into a medical REIT, which actually was an outstanding performer in the most recent period. But all the REIT portfolio, again, still continues to be favored. It continues to throw off a higher dividend return for your portfolios. And again, although they're letting me talk about it, all of us feel good about the REIT portfolio. And with that, I'd like to turn it back over to Len to talk about international.
Thank you, Stan. The international area at this point is actually a somewhat fascinating area to look at because there's a lot of uncertainty regarding a number of things out there. You have Britain still trying to figure out a way that they're going to exit the EU. You've got a trade war with China. You've got a global slowdown that has been going on. and who knows exactly when that will end. We do feel that we're nearing the end of that cycle, and so we feel a little bit more comfortable going back into international. International has been an area that has underperformed the United States stocks for quite some period of time at this point, and it represents a good value. And so at this point, we are moving from our minimal possible allocation in international towards something more of a normal allocation in international. We had a spirited discussion about whether or not we wanted to get into emerging markets at this time as well. And we see the emerging markets area as a very good long-term opportunity right now, but we don't feel comfortable pulling the trigger quite yet, given all of the uncertainty regarding the trade war and other issues. So at this time, we're going to maintain our international allocation in the more developed economies of the EAFE index, the EAFE, and we are, as I said, moving towards a more normal allocation there. With that, I'd like to turn it over to Bob to talk about the changes in our other holdings.
Great, thanks so much, Len. So both Stan and Len have alluded to some of the changes that we made in our holdings this quarter. I would say that from the research standpoint, the most significant increase was our increase to international equity. We feel positive on that, as Len mentioned, because of valuation, and also we're slightly more optimistic on the outlook for a trade agreement with China. With the caveat that it's virtually impossible to forecast how that's going to play out. There seems to be a little more optimism around that particular topic. We slightly increased our allocation to REITs, as Stan mentioned, based on their very strong relative performance in high income. And I would just add to Stan's comments that if you look back over the last 40 years, REITs have outperformed the S&P 500 on a total return basis by almost 200 basis points. So you can understand why we like them in your portfolios and favor them as a solid long-term total return investment within our investment portfolios. Len talked about our addition of a short-term high-yield corporate ETF, which we purchased as a result of valuation and a desire to boost income within that sector as well. We did reduce bond duration very slightly as a result of our belief that we think interest rates are bottoming. We have been sort of favoring shorter duration anyway for some time, as you know, and we went actually a little bit shorter in terms of our duration, again, because of our belief that we think interest rates are in the bottom of processing, are in the process of bottoming. So I would say that I would also just finish up by commenting that we do continue to hold several sector-focused ETFs. We hold the medical device technology ETF, a software ETF, and also a medical REIT ETF, the Medical Properties Trust ETF. All of those, we believe, offer good opportunities within each of those sectors. Clearly, we see healthcare as a solid long-term growth area, and software also as a solid long-term growth area. Both of those, we think, have growth with less overall volatility and less susceptibility to the economy, and that's why we like those as sector holdings within your portfolios. With that, I'll turn it back to Stan for a sign-off.
Thanks, Bob. And of course, we thank you all for listening once again. Again, reminding you that all of our previous sessions are on our website, and I look at them periodically, and I'd suggest you might do the same. Again, the information that I commented on earlier 6 years ago in dealing with, again, governmental actions as we are once again. At these sessions, we always do look at what could happen to change our views over the next quarter, and they don't usually change anything because they're unlikely to occur. In this quarter, we said if we saw core inflation go up to 3%, and just reminding you, currently core inflation is closer to 2%, then that would cause us to rethink the views that we've expressed at this meeting. Again, Remember, we don't think that's going to happen. We've only had 2 triggers activated in the history of the firm. So again, that's not something we anticipate. But if we did get core inflation ticking up, we'd be concerned about Fed action and other actions that might occur because of having experienced higher inflation. But with that, I'd like to again thank you and sign off and hope you tune in again next quarter.